Greetings, everyone. This is Cathie Wood at ARK Invest. Well, it certainly has been an exciting week. I guess you could call it an exciting week. It's given us lots of opportunities. We had an analyst join us today. First day is today, Will Summerlin. He will be following artificial intelligence and partnering with Max Friedrich on our fintech strategy. And the first words as he was introducing himself today to the rest of the firm, his first words to us were, it is an exciting time to be alive, and ARK is at the forefront of all of the amazing changes taking place out there. So that was very gratifying to hear, especially after the last few weeks. I know there's a lot of fear, uncertainty, and doubt evolving in the world out there. But we're doing a lot of original research. We have a 5-year investment time horizon, and we are truly excited about the opportunities that the last few weeks have presented us. As you know, our minimum hurdle rate of return for any stock to enter our strategies is 15% at a compound annual rate over 5 years. That's a doubling over 5 years. Well, you can imagine what has happened over the last few weeks. Market activity alone has taken that projected rate, and again, it's just a projection. We could be wrong. The world could end. I'm sure I have compliance monitoring me very carefully when I say this, so I want to say it correctly. But according to our projections, what these last 2 weeks have done is handed those who are averaging in to these sorts of strategies, any innovation strategies, a gift, because we do believe we're on the right side of change. And disruptive innovation, transformative innovation is going to deliver exponential growth trajectories for many of our companies. In fact, most of them. The growth rates are enormous, and I think some people find them unbelievable. To give you an example, electric vehicles. We expect unit sales of electric vehicles globally, including China, to compound at an 82% annualized rate during the next 5 years. Most people, when they see a number like that, they'll just say, I don't believe it. It's not possible. And the reason for that, the reason we face that skepticism often, is because of where the automobile industry is right now. It's very mature. It's not growing. In fact, we believe it has peaked. And that means all cars are in secular decline if we are right, that we are moving into more of a ride-sharing, both human-driven and autonomous during the years ahead. So this idea that electric vehicle sales could grow at an 82% annual rate, just not going to believe it. And so that skepticism festers, especially, I would say, among institutional investors whose analysts on the auto sector, for example, are mostly value analysts. So there are a lot of those disconnects in the world that are creating great opportunities for us. And so I wanted to say that at the outlet because Will is onto something. You know, there are trends evolving here that are really fostering a lot of skepticism, especially the growth rates and the sustainability of the growth rates. But our research based on Wright's Law gives us an extreme sense of confidence that we are on the right track and that truth will win out. And the other thing I think is going on, and I do think this is going on, we have noticed and our intermediaries have noticed that there's been elevated options activity in our funds, both on the strong days and on the weak days. Well, that probably is the case. And here I'm going to give you a sense of why I think that's the case. I think that there is a big difference between the way institutional investors look at investing and retail investors. I mean, we know that the Tesla example is a good one to illustrate the differences. And I know there was a lot of frustration, and it seems to have been pent up over many years, about Tesla and you know, our research on it. Lots of fear, uncertainty, and doubt with which we had to contend. But we thought it was a good thing, the debate. A lot of institutions are not set up actually to analyze a stock like Tesla. And I'm not saying all institutions, but I'm saying most institutions. And the reason for that is after the tech and telecom bust 20 years ago, almost to the day, March 10th, it started 21 years ago. And then on top of that, the 08-09 meltdown in the equity markets and the bond markets, there developed a lot of risk aversion, and volatility became a bad word. We have a volatile strategy, and we use that volatility to our benefit, trading around positions. Volatility is not a bad word in a bull market. Volatility, you've seen what happens in a down market. What has happened is institutions tend to be very benchmark sensitive. And I'm going to use Tesla as an example here. Tesla, as you know, many of you know, did not enter the benchmarks until last fall, when it was over $500 billion in market cap. So there was a lot of there were a lot of investment returns to have up to that 500 billion, and we were happy to be there. And we're happy that institutions are joining us now, but they're joining us primarily because Tesla entered the indexes. I'm not sure they really are trusting this. And the reason for that is their auto analysts tend to follow the traditional auto industry. And the traditional auto industry is very mature. And as I mentioned before, we think it's in decline. We are focused on exponential growth opportunities. We believe a subsegment of the auto industry is going to see exponential growth for the first time in 100 years. And so that's our sole focus. Institutions have hired analysts to focus on an industry that is mature, and now there's a transformative, really revolution taking place that will alter the auto world completely. There was a lot of skepticism. The auto industry itself didn't expect electric vehicles to amount to much of anything I think they thought it wouldn't take until the mid-20s. Well, it's here. And we began to invest aggressively in this space on that assumption as we saw battery pack system costs decline as rapidly as they have been declining. And so I think that kind of tug of war between the traditional backwards-looking world, which is based on benchmarks, and certainly the top positions in benchmarks are where they are because of past performance. ARC is focused on the future, especially on the future that involves transformation. And so benchmarks, I think, have been an impediment, and setting up research organizations in the way they've been set up is also an impediment to some of the new ideas. The other difference between what ARC is doing, what a lot of retail investors focus on, is time horizon. I know that institutional investors are much more short-term, many, not all, and they're very focused again on the benchmark. So this idea of being graded every year based on how well an analyst or portfolio manager did relative to a benchmark is quite constraining. The luxury we have, and retail investors have, is retail investors really don't have career risk. We might have a little bit more of that, of course, given what we do, but we have a 5-year time horizon. That is a luxury. That's a luxury. And the difference between linear growth and exponential growth in the early years, when electric vehicles are at 500,000 a couple of years in sales globally, last year 2.2 million. In those early years, because the bases are so low, there doesn't look on a graph to be that much difference between linear growth and exponential growth trends. You give that a few more years, and the difference is quite surprising. I mentioned that 82% growth rate. We really believe that's going to happen, especially now that China is pushing hard. I don't think traditional auto analysts still believe that could happen. The third issue that institutions are grappling with, that we are not, and that retail investors are not, is that the analysts are very siloed and specialized by industry or sub-industry or sub-sub-industry. That is just how the market evolved over the last few years. The problem with that is these new innovation platforms around which ARC has centered its research and investing are cross-sector in their ramifications. So it is the platforms that we have centered our analyst responsibilities on, and they are generalists, and all of them are comfortable with technology. Very comfortable. Healthcare-oriented analysts, very comfortable. Industrial, you do not find that in institutions. And I truly believe that research departments in institutions will have to reorganize in order to invest successfully or optimally, shall I say, in innovation going forward. Our analyst responsibilities, as I said, broken out by platform and technology. And the reason that's becoming more important is because the platforms are converging. So it's getting even more complicated. Autonomous taxi networks involve 3 of our platforms. And you've heard me say this before, but some of you may not. Autonomous vehicles are robots. That's one of our platforms, robotics. They will be electric, so energy storage, battery pack systems, another one of the platforms evolving out there. And they will be powered by artificial intelligence, another one of our platforms. It is very difficult in a traditional institution, which is very siloed, to have analysts collaborate in that way. They haven't been set up to collaborate. Our analysts are all about collaborating. So the world is changing. We set up ARC to accommodate or acclimate to this new world. And as you know, we are sharing our research on social media so that we can engage with and become a part of the communities that are innovating. So we are receiving insights, I believe, because we're willing to share our research. We're receiving insights about our research from those in the field. Are we making incorrect assumptions? That would be good to know early in an exponential growth trajectory, because if you make an incorrect assumption in the early stages of investing an exponential growth trend, and you carry that mistake out, you can make big mistakes. So just wanted to share a little bit why the disconnect between traditional institutions and perhaps what we're doing, and by the way, how we complement what they're doing. We think that because of their focus on benchmarks, which is more about what has happened historically, the risk of the companies in their portfolios being disrupted by the new technologies is going to cause them to, or their portfolios to populate increasingly, we believe, with value traps. So we're a good hedge against the broad-based benchmarks out there. So as Will said, yes, it's exciting to be alive, and we're as excited as ever about everything we're doing. The last few weeks hasn't done anything except increase the returns that we expect from each of our stocks to the extent they've come down. It's only the market that has changed that. Because a 5-year investment time horizon, doesn't, the research doesn't change. We haven't seen anything to change our research assumptions or conclusions. In fact, during periods of turmoil and elevated risk and fear, uncertainty, and doubt, innovation actually gains more traction faster. The coronavirus was the best example I've ever seen of it. But even markets like today will, since we're still in a period of heightened risk around the coronavirus, will probably encourage decision makers who were maybe on the fence about a new technology to jump off and just say, okay, let's go. So I am never afraid of times like this. And just to address one other question, this bubble question. We are not in a bubble, although compliance would have me say, I do not believe we are in a bubble, rightly, is because of how many questions we get about being in a bubble, and how much fear there is that we're in a bubble, is because the seeds of what we believe will happen during the next 5 years, so these 5 innovation platforms involving 14 technologies, the seeds for all of them were planted more than 20 years ago in the tech and telecom bubble, and even before that, so the PC and the internet together. And then the internet, of course, the bubble, caused a rush of capital into they were actually the dream at the time. The dream was right. It was just 20 to 25 years too early. Amazon maybe being an exception, an important one, and showing the way. And so therefore, we're in the period of reality. The seeds are beginning to flourish. We are ready for prime time. That is what we truly believe. And so this notion of a bubble, I think, is born, once again, out of the benchmark sensitivity and backwards-looking nature of a lot of institutional investors out there. So the other thing I'll say about this is what they should be worried about is not our strategies or innovation-based strategies. They should be worried about their strategies because the other side of disruptive innovation is creative destruction. And when we're talking about the S&P 500, we think creative destruction is going to impact nearly 50% of the S&P 500. And that we measure in 2 ways, by looking at the fixed assets out of there that will become stranded. And there are hundreds of billions, if not trillions, of fixed assets out there that will be stranded. And of course, we also look at the market cap exposure in those groups. I'm going to fly by now the usual drill, which is monetary policy, fiscal policy, economics, and markets. Because I did speak about these things last week. But a few things did happen this week. Chairman Powell of the Federal Reserve, I guess in a Wall Street Journal article, was not forceful enough, according to investors, in saying that we are going to keep interest rates down at all costs. I think a lot of investors wanted to hear him say, yes, we're going to try and control the yield curve. Well, by the way, that really has never worked in our country, so I don't know why investors would think that it would work this time. And he did note the disorderly market, although I think a lot of people misinterpreted some of what he said. We believe that interest rates going up, and it has been a shock when you think about it, going from 1% to 1.5% on the 10-year Treasury in the span of a few months is like a tsunami through the bond market, right? That's a 50% increase in yields. This is crazy talk in the bond world, but it's happening. And I think there's a lot of confusion and risk aversion, which has spilled into the equity markets. We'll take the other side of that trade. Interest rates going up, long-term interest rates, we believe are suggesting that real growth is going to pick up. Now, I know there's an inflation component there, and we are going to see the base effect of last year's drop in prices during the coronavirus. So we could see the CPI in the 3 to 4% range. It will be temporary. And we do believe that deflationary forces associated with disruptive innovation, and they're massively deflationary, combined with the deflationary forces of those companies who are going to be put in harm's way by this disruptive innovation and who have leveraged up too much historically, usually to cater to short-term oriented shareholders and to buy back their stock, not invest enough in innovation, they are going to have to cut prices ultimately in order to sell goods and service their debt. So I think those two forces are going to combine. Now, this isn't today or tomorrow. We think the today part is the deflationary undercurrent associated with innovation. But we do believe that as those forces come in and disrupt the traditional world order, this other source of deflation is going to occur. The one deflationary force is good deflation and will spur growth. The other force is deflationary and bad in that it will probably lead to duress and bankruptcies and reorganizations and so forth. So I think there will be a lot of confusion out there in the marketplace. And so keeping your eyes and portfolios on the right side of change is going to become very important. So fiscal policy, government spending is nothing more than future taxation in one shape or form. Whether it's inflation, which is a regressive tax, whether it's outright taxation, which this administration seems to be veering towards. This is not good. Capital gains taxes, corporate taxes, tax rates going up. I think it shouldn't surprise the market. The fiscal policy, the fiscal stimulus has been in place for more than a year now, or for about a year now, and with that is going to come taxation. Well, now rubber's going to meet the road. We'll find out what kind. And but I will say, the closer we get to next year, the lower the odds of some very harmful taxes, because we'll be looking into a congressional election year, and the House is very close in terms of the number of Democrats and the number of Republicans. Nonetheless, I can tell you that's not good news. We don't have our rose-colored glasses on there. In fact, we never have rose-colored glasses on, contrary to what some might think. And then on the economy, we did get the employment report today. The employment report was a very good one, much stronger than expected from a headline point of view. Again, looking into the guts of it, there was an offset. There was a big offset. The average work week dropped by 0.9%. So that's month to month, annual, and that of course has a big impact on income. So we think the two pretty much wash each other out. We also think one of the things that's happening here is, especially in leisure and hospitality, a lot of people would not show up for work because they were being paid by the government not to show up for work effectively. And so maybe some of them are going back to work. That's a source of the employment gains, and leisure and hospitality was the biggest one. And those, therefore, the people who had been picking up on their shifts, they may be taking a lower work week now. We still think we're in a V-shaped recovery. This report does nothing to suggest otherwise. Inflation, if you look at the wages in the report, quiescent, 0.2%, in line with expectations, no change there. Interest rates have gone up this week. I think that's a manifestation of growth that's revving up and is going to gain more momentum as the vaccine spreads. And I think that's going to be great for profits. We think profits, I used to say they'd end 2021 at a $200 rate for the S&P 500. Now we're thinking it could average that for the S&P 500. So the market on this year is selling at 19 times. If you start looking into next year, which we will starting June, that's how the market cycle tends to work, it's even less expensive than that. So now one of the things that a lot of investors say, well, interest rates have gone up. Of course, this is a killer for your strategy. I don't think the market's ever priced in interest rates at 0.5% on the 10-year Treasury, or today 1.5%. I think that the market, I went through this in a previous video, the market has been assuming that interest rates would normalize somewhere in the 4% or even 5% range. And that's how, taking the inverse of that, we got to sort of a normalized PE in the 20 to 25 range. Couldn't get through there. 1 over 4% is 25, 1 over 5% is 20. So we don't think the market has priced any of these low interest rates in. And so to say that these strategies should go down because of interest rates, we just don't buy. And then in terms of what's happening in the markets today, let's address the equity market. There's a big rotation taking place. It's moving from growth into value. Now, this started in the fourth quarter, and the surprise to us is that our strategy had held up as well as it did until the last 2 weeks. We were beginning to think, oh, maybe they can coexist. Well, we don't think they can coexist, but what I'm about to say might surprise you. If you're the algorithms out there, and the market is highly algo driven these days. We learned that from the coronavirus, when algos just ripped through the market and sold stocks that had small cash cushions and were in a cash burn situation. And many of those stocks held solutions to the problems. So they were cut by 2/3 at that time. It made no sense. But these algorithms, if they're given just two variables, they're probably going to make a lot of mistakes. If the variables they're using today are price to book and dividend yields, then we think that they're going to be very wrong, because those kinds of value stocks probably haven't been investing very aggressively to become a part of the new world and the innovation that's burgeoning today. There are value managers out there, very good ones, who understand their biggest risks are value traps caused by innovation. So they're picking their spots very well. But be careful, because value, we believe, is going to continue to face massive headwinds, especially those companies that have not invested to move into the new world. And even retail, many people say, well, can't possibly hurt retail any more than it already has. I can tell you that's not true. So if you look in the United States, online retail as a share of total retail is roughly 20% now. It grew at 4 times the pace this year, or in the last year, as it did the prior 4 years. So 4 years into one. So it's close to 20%. If you look at S-curves, where does the sweet spot occur? It starts happening in the 10% market share, 15, 20, and then there's the takeoff. And given the coronavirus now, we're all much more comfortable shopping online. There were some who just wouldn't do it before. They had too much of a habit going or something. That's changed. And so I think anyone who thinks we're going back in time is mistaken. And of course, retail, financial services, energy, this increase in energy, that's almost what makes me feel good about what's going on. If you look year to date, energy stocks are up 37.5% and financials up 13%. Much of that occurred in the last month. 22% increase in energy just in the last month and 8% in financials. So that accelerated appreciation is what has caused this rotation algorithm saying, okay, past is prologue, it's happening faster, let's get rid of our growth stocks and let's go into value. The fact that those two sectors are at the top of the league tables this year and in the last month makes me feel good from a couple of points of view. One, the bull market has broadened out. It did not narrow into one strategy like the internet in the late 80s. That was a recipe for the tech and telecom bust that we saw. So this rotation is healthy, a good correction, shakeout is healthy, great time to average in to strategies you like. And I do believe, on the other hand, that energy and financial services are going to be two of the most disrupted sectors thanks to electric vehicles, autonomous electric vehicles, and thanks to digital wallets. Those are two and three of the biggest opportunities brewing out there. So the fact that energy and financials are leading the pack suggests to me that this is not going to be long-lived. I'm happy they've had such a burst, and the other algo rule here is move from high value stocks, high valuation stocks to low valuation stocks. So again, be careful. A lot of low valuation stocks are going to be set up for disruption. And then there are rules like, okay, let's follow the price momentum. Just it's a Momo trade. And again, if truth is going to win out, that will be a losing strategy. So I guess the last thing I'll leave with you is a stat that I saw just today. It's cash in money market mutual funds. Now, cash in money market mutual funds soared during 0809 for understandable reasons. There was so much fear. And of course, that led to sort of a deflationary, disinflationary period. I was surprised to see that cash in money market mutual funds, now maybe there's a technical explanation, but I don't think it can be this big, is higher now than it was in 0809. It had started to come down, and now it's moving back up again. And I think this makes sense because, as I've mentioned many times, the equities have seen outflows pretty consistently since 0809. There's been a flurry here and there, but pretty consistently. Fixed income has seen inflows. Cash is part of fixed income. These last 2 weeks probably has renewed the decline in equity outflows, and yet at the same time potentially a decline in fixed income, especially long duration fixed income funds. What do you do with that? You put it into cash. So that's very interesting. The cash is building on the sidelines, and we do believe there is going to be an asset reallocation. You could see it towards stocks and bonds away from cash. Bond yields have gone up. Let's extend our duration so that we earn a little bit more on our money. And for stocks, let's have a barbell strategy: bonds and equities, maybe even higher octane equities. So we're looking forward to sharing with you more videos like this, and probably focusing more on the exponential growth trends, just how powerful they are out there, how unstoppable they are if we're right, and the cost declines associated with Wright's law are going to be as powerful as Wright's law suggests. And then you will see how getting on the right side of change will be a very good idea. And not just in investing, getting your children focused on the right side of change, or your grandchildren in terms of their education and inspiring them, I think will become very important as well. So I hope you all have a wonderful weekend, and we will be updating these videos during this tumultuous time. We're going to be there for you. We want you to know what we are thinking. As you know, we're radically transparent. We're not a black box. And we want you to share this journey with us because we think it's going to be an exciting one. Okay, so thank you very much. Have a lovely weekend.